Greetings, everybody. First of all, I'd like to thank everybody for their support of Value Investors Edge. We're having another phenomenal year. I just personally finished up a move to Las Vegas, working on finishing up this PhD program, hopefully defending within a few weeks. We have an exciting opportunity. It just won't take up too much of your time here before we get into the Money Show video, just quick 1 minute. But we have free trials available for 72 hours. They're available until this Thursday at midnight Eastern time. This will be the last time we have free trials available until the end of the year. We're planning probably some sort of end of the year promotion. We'll probably have an increase in the dues as well at the end of the year. But now's your chance to try it for free for 2 weeks. If you decide to sign up after those 2 weeks, your membership rate will be locked in. You'll never have a price increase or anything like that. We always do that for our members. Again, it's a really exciting year just to share with you guys. This is the model performance as of today. I'm recording this at the close of market on Monday, September 18th. We're up 39.6% year to date as of 2023. You can see our two shipping models. They're long only models, no options, no leverage, very easy to follow. Those are shown below here year to date. Over our past 8 years at Value Investors Edge, we've posted this performance. The first 3 years were from the annualized average of tracked trades. And then starting in 2019, we launched our long only models. You can see that performance there, which I'm very proud of. 43.4% annualized return. That compares to 8.8% from the shipping industry and between 6 and 13% from the indices, depending on which broad market comp you want to take there. And I know sometimes this gets lost in translation. So here's an illustrative example, just an example, hypothetical, of course, but what would happen to 20,000 over the course of that time from 2016 to 2023 year to date? You can see the outperformance is quite striking when it's expressed in these terms. Don't take my word for it. Ask anyone else who is a member of Value Investors Edge what they think about our research product. Try it for yourself, 2 weeks free, and then make that decision whether or not it's good for you. Again, thank you everybody for your support. I realize our research is expensive, but I believe we earn our research fee each and every year. We also have a more value-oriented newsletter, which is $3.99 per year that you might want to consider if our research fee is a little bit too high. With that said, let's get over to the Money Show content, and I look forward to your feedback in the comments below.
All right, everyone. Hello and welcome to another Money Show Virtual Expo. As always, it is wonderful to have you here. Without further ado, please join me in welcoming our first speaker of the day, Jay Mintzmeyer, a renowned maritime shipping analyst who directs the Value Investors Edge research platform on Seeking Alpha. He also hosts a regular virtual investor forum for those who are interested in the shopping and infrastructure industries. Now, to our live audience, please type any questions that you may have into the chat box, and time permitting, we'll try to get to those at the end of the session. With all that said, Jay, I will hand the mic on over to you now. Be right here if you need me, but the floor's all yours.
All right, fantastic. Well, thank you for that introduction, and it's good to be back with everybody here at Money Show. We just relocated to Las Vegas, so please excuse the mess setting up my new office. Yeah, hopefully the next one will be a little bit less cluttered back there. Anyways, it's great to be back. I've been doing these events with Money Show for about 3 years now, usually about once every 3 or 4 months. So I'll come on and provide a market update. We're going to do the same thing today. We'll spend about 5 minutes talking about kind of our service and what we do, about 10-15 minutes on the market and some sectors, and then we'll do some Q&A at the end. Usually when I start these out, we hold ourselves accountable. We do a previous performance review, and we talk about how the previous picks performed the last time we were on Money Show. And, you know, we're going back a year here. So last September 8th, 2022, our Money Show presentation had 4 picks, and those picks were up 16.7% in 4 months. And the S&P 500 was totally flat at that period of time. So 16% outperformance. You say, why 4 months? Well, that's because that was when the next Money Show event was. It was January early this year. Maritime shipping set to outperform. Our 3 picks went up 25.7% in 7 weeks. So a blistering return last time from January. The S&P 500 was basically flat again during that period of time. But last time we came on, it was in March, and we had 3 picks, and it's been 6 months, and they're down a little bit. They're down 4.3%. Which is flattish, right? But the S&P 500 went back up. So this is the first time we've actually underperformed the S&P 500 in quite a while, but we always hold ourselves accountable, and we always do these performance reviews at the start. Just a throwback before we get going, the very first show I did with Money Show was in August of 2020. We shared 5 COVID-19 recovery plays. So there's a pics there. The video, that the receipts, as it were, is on YouTube. So you can see that this was legitimate. But these were the 5 plays that we selected. And a lot of people say in shipping, you can't hold these things long term. They're not long term investments. And I think that's really a misnomer. And so that's why I wanted to show this today. This is the performance over just over 3 years. These are yesterday's closing prices. And you can see the average return of 322% in 37 months. And the S&P 500 is only up 37. Now, 37 is okay, right? But would you rather have 4 times your money, right? So just 2 misnomers I want to dispel. One is that folks think you can't hold shipping long term. And this clearly shows that if you have the right entry level, if you hit the cycles correctly, if you pick high quality companies, you can. The other misnomer, misconception, is that shipping companies won't return capital. And I want to show you the starting price on each one of these and the dividends they've paid out in just 3 years. Now you see almost every single company flex more dividends than the stock price. Global Shipley, 75% dividends in 3 years. Dorian, more than the entire stock price. And Starbulk, about 150% of the stock price. So I want to dispel 2 of those misnomers before we get going. So talked about what we're going to do today, and we'll jump right into it. So most of you all are probably familiar with Value Investor's Edge. If you're not, we're a boutique research firm. We're focused on maritime shipping. We have a team of 6, but we have 4 front-facing analysts. Myself, James Catlin does the macro, Michael Boyd does our energy, and Clement Mullins is stepping up as our lead analyst in shipping. Our long-term returns, hopefully they speak for themselves, but the first 3 years were the average of our tracked trades, because we didn't have a model portfolio specifically. Starting in 2019, we figured, hey, long-only model portfolio is easier for everybody to track. And so we transitioned over to that. But as you can see, our annualized return is 43.2% as of yesterday. And that might not seem like a ton, but look at the cumulative, right? That's basically 15 times the money over 8 years. So a massive outperformance, 10 times the S&P 500, about 17 times the Russell, 15, 16 times the shipping industry average. So, past performance is not a guarantee of future results, but we're going to do our best and we're going to stick to our process. Getting right into the shipping cycles, if you've seen a previous one of these, maybe the one in March or in January, or you've seen my YouTube videos, we're in a pretty similar situation here. There hasn't been a whole lot of changes since, say, March of this year. So in 2021, we had these massive returns, right? The global economy was reopening. And in 2022, we had all these disruptions. And so now we're kind of at the juncture where these shipping company stocks are very attractive on a valuation basis. The balance sheets have never been stronger. It's just a matter of whether or not we can get more investor attention, how much the capital returns are going to be, the dividends, the buybacks, those sorts of things. So year to date in 2023, we're tracking the S&P 500 on an industry basis. Now, that's after outperforming by 40% in 2021, outperforming by 75% in 2022. And I think there's more gas in that tank. I think the shipping stocks could easily outperform by another 40 to 50%. But I think there's just so many, broad macro jitters that are holding these stocks back. And I think that provides investors with a great opportunity. So some of the tailwinds I want to talk about and sort of catalyst, as it were. The number one catalyst is surging cash flows and shareholder returns. Hopefully you saw in that first slide where I illustrated the 5 companies that we picked in 2020, that dividends are serious with the right companies. And that's important. You have to select the right companies, the right management teams. Now, tanker companies are right on what I believe is the precipice for a super cycle. I don't like to throw that word around too lightly, but that potential super cycle could run through at least 2026. The balance sheets across the industry, all sectors, are the strongest in history. Never seen. There's actually one company right now that has negative leverage, like they have net cash. I've never seen a shipping company with net cash. And by Christmas, we should have 4 different shipping companies that have net cash negative leverage. Never seen it ever before. Balance sheets are strongest in history. I expect significant dividends and repurchases across almost all sectors. Obviously, it will depend on market performance, but I still expect to see that, especially into 2024. Now, global regulations are hitting the fleet. 2023 was the first year of the EEXI and CII. That's the carbon emissions system and the engine design requirements. Now, 2023 was kind of a phase-in sort of year. So I really expect that impact and fleet slowing to start probably January, February of 2024. We're going to see some future carbon tax and other propulsion rules kicking in. I call it IMO 2030 because that's like my estimate of when it'll happen. But the IMO even said they're shooting for 2027. That would be amazingly bullish if they can do 27. I don't think they can, but we just kind of call it informally. We call it IMO 2030. And finally, these oil markets are getting extremely tight. Combined with the OPEC plus cuts on one hand, combined with this ESG hesitancy, right? The lack of drilling, new land permits, new offshore leases, all that sort of stuff, especially in the US and Europe, we're in the tightest oil market right now. Oil's over 90. We're in the tightest oil market balance we've had since 2013 or 2014. I mean, it's been a bad decade for oil, right? I mean, if you think about it, but we're at the tightest balance we've seen since then. And if the global economy stabilizes, these OPEC plus cuts are not sustainable. They're not going to be able to hold them unless they want to shoot. If they want oil to go back over 100, 110, 120, then maybe they can keep the cuts going. But I think once we get to January, February, March, it's going to be a different scenario. And that lends itself well to tankers, because crude tankers are very heavy on oil on water. So once OPEC plus picks those exports up again, expect crude tanker rates to go ballistic. Now, some of the macro headlines, and this is stuff that I'm sure most folks are kind of aware of, but just to reiterate, the global economy is clearly slowing. Now, I don't know if it's going to be a recession yet. That's far too premature, but China's reopening is obviously quite weak. And China is one of the number one demand drivers for a lot of these segments. The number one demand driver for dry bulk in particular. And we'll talk about that in a few minutes, the rocky road to recovery in dry bulk. Inflation is still kind of a headwind. It's hurting consumer power. It's forcing central banks to raise rates. One of the concerns I had early in the year was that if the inflation was really sticky or resurgent, the central banks might kind of overreact and raise the rates a little bit too fast. We haven't really seen that the central bank tapered off the rate increase pretty quickly. It looks like they're going to pause again next week in September and maybe do maybe one more raise in November. But inflation's sticky. I mean, there's no way around it. I wouldn't say it's resurgent, like it hasn't went back higher, but it's definitely sticky. And so those higher rates I think they're going to be here for longer. And finally, these disruptions we had last year with the war in Ukraine, with some of the sanctions, with the grain corridors, things like that, on average, they were bullish. They made shipping less efficient, which kind of synthetically reduces supply, getting a little wonky here, but that makes rates go up, generally speaking. But any sort of crazy conflict escalation is bearish. And so when we see these China-Taiwan tensions increasing, we have news of things like the North Korea and Russia apparently doing arms deals. Ukraine is still a mess. That's concerning, right? That's something we need to keep our eye on. It doesn't mean that these companies aren't going to do well financially, but it's just, and this is true for any sector, really, any international company needs to consider these sorts of things. So with that, I'm going to get into the three segments. We'll do tankers, container ships, and dry bulk. I'll try to do about 10 minutes total for all three, and then that'll leave us 10 minutes for Q&A. So if you have any questions, just feel free to post it into the chat, and our moderator will form a queue, and we'll jump right into those questions at the end. So with tankers, and super cycle is a loaded word, right? We're talking huge returns. I mean, during 2003 to 2008, most tanker companies made between 10 and 40 times their money. So that was a true super cycle. The container ships just went through a super cycle. Danaos Corp, DAC, went from $5 at the bottom to 107 at the top. So 21 bagger plus dividends. Even now it's pulled back a little bit. Even now it's a 16 bagger total return. So that's when we say super cycle, that's what we're talking about. We're not talking about measly, peasly, 50%, 100%. We're talking 5, 10, 20 baggers, right? And so I don't like to throw that word around too lightly. But it is, I think, the highest potential, at least I've ever seen, for a very, very bullish run. For those who've been following the tankers, you remember, of course, that the COVID-19 impacts gave this sort of whipsaw effect to the market. We had this little floating storage craze, and then tankers were just decimated for 2 years. There's a little bit of oversupply. There's a really slow global reopening. And then finally, things started to tighten up. I think they were already starting to get a little better in 2022. And then Ukraine kicked off. And that just totally blew the market apart, made everything more inefficient. Europeans were scrambling to front run the sanctions, get distillates, build up their inventories. Russia was scrambling to export as much diesel and crude oil as they could before the sanctions. So we had just a wild, bonkers tanker year last year. I mean, 2022 was the strongest product tanker year in history. It was actually stronger than that super cycle I told you about, 2002 to 2008. is even stronger than that. Now, crude tankers were like the third or fourth strongest year, but product tankers were the strongest in history. So keep that in mind if you're looking at rate charts and you're doing year over year comparisons. I know a lot of people are like, hey, Jay, the rates are weaker this year than last year. Why is that? Well, think about what you're comparing to. So big picture here with the tanker market, and I got a lot of charts that'll kind of walk us through this, but we have the oldest fleet balance in history, walking into the most significant environmental regulations and propulsion regulations in history. So you smash those two things together and you get a severe, severe supply shortage if the global economy doesn't completely melt down or face plant. So if you think the global economy is even flat, I mean, you don't even need to grow, just flat global economy for 3 or 4 years, the math does not add up. And we're going to have a severe shortage of tankers. And it's just supply demand market. And you've seen this before in other shipping sectors. You saw it in container ships with the supply chain crisis. We're seeing it in LNG and LPG right now. We saw it in tankers before in 2019 when they did Costco sanctions. Anytime you have a severe supply shortage, those rates go ballistic. They don't go up 10, 20, 30%. No, they go up 2, 3, 4, 500%. And we're running headlong into that. We have extremely few order book, like new build deliveries coming between now and 2025. They're starting to order some now for like 2026, but even that is still a meager amount. And so that's why I say we have the potential. And in the overview, I had a question mark there because it's not confirmed, but I think the setup is quite nice. So our top pick in tankers, it's a clean tanker company. It's called Scorpio Tankers. It's US listed. They only own product tankers. So product tankers carry gasoline, diesel, jet fuel. I like a lot of the crude carrier companies as well. But right now with the OPEC plus cuts, there's going to be some near-term headwinds for regular crude tankers. Now, near-term 3-4 months, long-term investors should be looking at what I've been talking about in the next 3, 4, 5 years. But for product tankers, the refineries are just switching over. They're starting to switch from the summer blends to the winter blends. September is normally the weakest month of the year. And we're seeing rates that are, it's one of the strongest Septembers I've ever seen in August and September. So I like the clean trade because it's not impacted near term by those OPEC plus cuts. They're going to depend a lot more on the refinery runs, the end jet fuel demand, things like that. And 2023 is shaping up to be, hopefully, it's going to be a record year and finally surpass 2019. And it's looking that way. So here's some of the other tanker firms to consider. I like a lot of those as well, but Scorpio is my top pick today. Full disclosure, I'm very, very long this position. I have all sorts of stock, options, everything in this position. And so just want to disclose that. Of course, I run my own portfolio and I always share my own positions just so I eat my own cooking. So this chart here, this came out in January of this year, and this shows the expected impact from the diesel rerouting from all the sanctions. And that's been kicking in throughout the year. Now, we have some issues on the crude side where I don't even know if the sanctions are bullish anymore, the crude tanker side of business, because the price cap's been totally blown through. And there's a lot of older, rusty ships that should be demolished that are still in the trade. But on the clean side of the house, the sanctions have definitely been helpful. And this is showing the dislocation between where the refineries are located and where the consumers are at. And what sort of new, the orange lines are the additional trade flows. So you can see much longer routes than we had previously with the solid black lines, very short trade flows. So this is very bullish for product tankers, and I don't expect that to go away anytime soon. I talked about how the order book isn't big enough to renew and replace the fleet. This chart is from July 7th. We update these once a quarter, so the next update will be out in a few weeks on Value Investor's Edge. There's been a couple orders since, but the broad shape of the chart is the same, and all the orders are kind of like 2026, 2027. So you can see the order book this is the smallest I've ever seen in my career. There's only one ship coming next year, one ship in 25. There's like 7 ships left, and now I think it's 3 because this was done in July. So there's basically just like 5 ships coming in 2.5 years. And you can look back throughout history, and there's never been a year like that. In fact, the lowest 2 years we've ever had was 44 ships in 2014 and 2015. And then 2016 had 47 ships. And actually 2016 was a very good year for tankers. So imagine you had 24 and 20 and you had a great year, and now you have 1 and 1. So we're really excited about this setup in the VLCCs. They carry 2 million barrels of crude oil per vessel. So when you're really talking about crude capacity, crude tanker capacity, we really focus on the VLCC market the most just because they're the largest. But Suezmaxes are the next largest, and they carry 1 million barrels per tanker. You can see a very similar chart. They've had more deliveries now for 26, so this looks a little bit flatter now. But you can see there's 9 vessels coming next year, 16 and 25. So 9 next year, 25 over the next 2 years. That's the lowest again since 2014, 2015, when they had 18 and 25 the next year. So very low year. Once more, just so folks can see, say, hey, why are the rates not going crazy now? Well, we had a lot of deliveries. That's new supply, right? Higher supply, lower rates. We had a lot of deliveries coming in 2023, and now it's over, right? We're just about to enter Q4 in about 3 weeks here, and the deliveries are basically tapering off to almost nothing. In product tankers, very similar. We had a lot of deliveries that just hit the water in the last few weeks, last few months, and then it just tapers off to almost nothing over the next 2.5, 3 years. This chart here shows the fleet age. The green ones are the ones that are on order, right, the new builds. And these purple ones, or dark red here, are totally obsolete ships. The only reason they're even still on the water is really because of the sanctions, whether or not they're supported by Iran or whether they're supported by Russia as part of the so-called dark fleet. These vessels would not even be trading in any sort of legitimate market. All these vessels on the red are going to be obsolete within about 2 to 3 years because of the environmental regulations. In fact, anything built before 2013 is going to be obsolete probably in 2 or 3 years. So this entire chunk of the market, these are just totally like sanctioned dark fleet ships, and these are probably obsolete in about 3 years. And the green is what's replacing it. So if you basic economics here, it's a pretty beautiful setup. Product tankers, a little bit different because product tankers have been a growth segment over the last 15 years. Crude tankers been fairly stable. There's been a slight growth over the last 10 to 15 years in the global crude trade, but it's kind of leveled off. Product is still growing. In fact, last year, like I said, all-time record year. This year, probably going to be even bigger yet. Again, the purple or dark red, totally obsolete. The red, borderline obsolete. And then by the time we get to like 2027, everything built before this point in 2013, non-eco designs, they're basically going to be obsolete. And you can see the replacement tonnage. So again, a massive, massive skew there. So that covers it for tankers. We spent the most time there because I'm most excited about it. I think it's the most interesting of the segments. Container ships are pretty straightforward. I've talked about them before. It's really a cash flow machine. These are companies that have signed long-term 3, 4, 5-year contracts with the liner companies to provide ships. These are rock solid contracts. There's never been a default outside of bankruptcy or financial reorganization. So if you invest in these companies, the number one thing you need to do is look at the counterparties. Look at Maersk, look at CMA CGM, look at those companies, see how much cash they have, how much debt they have, can they honor their debts? And right now, the liner companies' balance sheets are still at the strongest they've ever been. Liner companies, even as recently as Q1, Q2 of 2023, are still reporting profits. And that's after the last 2.5 years they had. So that's the number one risk here. It's a pretty basic cash flow story. And so I like the firms that have the largest backlogs and the cleanest balance sheets and the best counterparty. And so my top pick in containers, also one of the cheapest, is Danaos Corp, DAC. They haven't done everything that I've liked. They've done a little bit of stuff with dry bulk and other segment investments. I prefer they stay just in container ships. So that's sort of been irritating to me. But other than that, their operational execution has been fantastic, and the valuation is quite phenomenal. Some of the other companies here that are in the sector are listed below. The macro narrative in containers is terrible, right? Everyone's like, the super cycle's over, it's played out, we're about to have a recession. Why would you want to invest in these companies? Well, the bottom line here is that all this stuff is already priced in. That's why you're getting a company at less than half their EBITDA backlog, right? You're able to buy a company that has, let's just say, $1 billion of EBITDA backlog, a couple $100 million of scrap value, and you can buy that for maybe 600 million, 700 million market cap. And the only reason you can do that is because all this sort of negative narrative is already overpriced into the stocks. I talked about the last couple times I've been on about how I expect surging free cash flow throughout 2023. And we're 2 quarters in, and that has absolutely been the case. In fact, some companies are going to have a stronger 2024 than 2023, just the way the structure of these rolling contracts works. Textainer, I talked about them. They had a substantial repurchase program. Triton, which is a peer of Textainer, and they're kind of a box lessor. They own the little 20-foot, 40-foot boxes. They were taken private a few months ago by Brookfield. So that sort of underpins the validity, I think, of our thesis. we've seen steady repurchases across the board from basically every single company we follow. Costa Mare had a recent massive repurchase. I mentioned Danaos Corp as my top pick. They're steadily repurchasing. So we're definitely seeing those returns. They could be bigger, yes, and I would like a bigger dividend, but the overall free cash flows have been fantastic. These are the broad freight rates, right? These are the rates that the big liner companies are getting. And you can see the full cycle. I mean, it's over, right? I mean, it looks just like a regular cyclical thing. Now, with this sort of mass, though, is that this little 2.5 year bump is about 25 years worth of profits for the liner companies. So it doesn't matter if rates are bad for 6 years straight. They made 25 years of profits in that period of time. Container leasing rates are what the actual ships that, because we're investing in the owners of the actual tonnage, the actual vessels. This is what they get per day to sign up for their ship for a year. And you can see these rates, interestingly enough, have not came back full cycle yet. In fact, they're still kind of sticky. And that's because we have a shortage of small feeder tonnage and mid-sized tonnage until about middle of 2024, maybe early 2024. So we still have kind of a tight market. And that's surprising to me. I actually thought the rates would have came full circle by now. So they're actually doing better than I thought they would. Finally, dry bulk, rocky road to recovery. It's all about China. China's reopening is not happening fast enough. That is basically the entire story in dry bulk. Right now, at this point, given the uncertainty, given the slowness of the recovery, I like a dry bulk firm that has a very, very clean balance sheet, solid management, good dividend policy. And that one's easy. US listed Genco Shipping. There's other dry bulk shipping names, and I have long positions in some of those as well. But Genco, I think, is just your safe bet. You can buy it now. It doesn't matter if it's going to take, it might take 6 months, it might take 12 months. But if you buy a company like Genco with a rock solid balance sheet, 8% leverage, probably 0% by Christmas, that's a really safe bet to just kind of buy it, wait, and bide your time for that recovery. The market's totally sideways this year, and that's just a factor of China not reopening very strongly. Normally, we see sort of an uplift into the fall. 2022 was, of course, very bad. We had the overall year was okay, but the seasonality was bad, right? The market fell apart into the winter. And this year, we're just flat, totally uncertain, kind of like, as I said, on that rocky road to recovery. And we're just waiting for the fleet balances to tighten up. I showed these same charts with VLCCs, remember, with tankers. With dry bulk, they don't look quite as good, but they're similar. Right? There's not a lot of new tonnage coming on. You can see most of the old tonnage hit the fleet 2009 to 2012. And that was, they ordered all of these in like 2008, right? During the boom and sort of the bubble there. And the ships just came on too late. And lo and behold, you have all these ships come on, you have a terrible decade of rates. And that's what we've had. Now the deliveries are tapering off. 2023 was kind of a large year, and then things slowly taper down. And then the Cape sizes look kind of like the tankers. Right, there's these obsolete ships over here. There's new supply here. The regulations are going to hit them as well. So I'm bullish on dry bulk, but I think it might take, with tankers, I think we're weeks or months away from the rocket ship leaving the station, as it were. With dry bulk, where it's a rocky road, it might be 6 months, it might be 12 months, it might even be 18 months. So dry bulk is more of kind of a wait and see, get a good company, hold on to it, wait for the turn. With tankers, we need to load the station because the train's about to leave. So review of our top picks, the tankers, which I believe are on the precipice of a super cycle. I like Scorpio tankers there the most. Containerships, the cash flow monsters. These are just to buy them and enjoy the free cash flow. Sit back and relax and let that cash come in. That's Danaos Corp. And then dry bulk, sort of the speculative. We're on that rocky road to recovery, and we're going to pick a safe company, Genco Shipping. So that's it. We have about 5 minutes or so left for Q&A, so I'm excited to hear what people want to ask.
Thank you, Jay. That was fantastic. We do have quite a few questions. It started right at the beginning, so it's possible some of these you may have covered. So do excuse me on that. But let's start with this from Nelson. He had just asked if you can bring the slide back up that have the routes on it. Do you know what he means by that?
Yeah, I'm guessing he means the diesel rerouting because of some of
Most
the
likely,
sanctions.
yes.
Yes.
And maybe if we can just leave that up for a minute while we cover a couple of other questions.
Yes, absolutely. And just a note, this was actually taken from Scorpio Tankers, as it shows on the bottom here. So they have a full presentation from January that talks about the sanctions and how they expect to benefit.
All right, fantastic. This one question from Initials VG is asking, how would you differentiate between the future of clean and dirty tankers, taking the current order book into consideration?
Yeah, no, it's a fantastic question. The short answer of it is over the medium term, the two sectors pretty much correlate. It's really hard to have a bullish crude sector without a bullish product sector, vice versa. And that's because the medium-sized ships, particularly, they're called Aframax size and crude tankers, basically LR2 size and clean. If you have the right design, like the stainless tank and the right coatings, you can carry those clean products. But you can also what they call dirty it up and carry crude. Now, that's a little bit complex process. It's really easy to go from clean to dirty, so to speak, but it's a little bit harder to switch back. But over the medium term, give it 6 months or more, their rates tend to correlate. So their futures are pretty much tied together, I would say. I think the order book on the crude side is a little bit better, but keep in mind that the crude side isn't really expected to grow. It's supposed to be just stable for the next 5-6 years, whereas product might grow 3 to 4% per annum. So I think when you factor in the growth differential, the order books are about the same at this point. Now, for the next 2 or 3 months, keep in mind it's less than 6, so they don't have time to converge. I like the clean sector better. Right here, Q4 2023, that's why I really like Scorpio and some of the other clean companies. I like crude tankers once we get into next 2020.
Thank you, Jay. And now I know that you have touched on these, particularly Zim, but we had a few people asking about them. So I'll cover this question from Joe Wolford. He asked it right when you started. I just wanted to get your take on the following stocks. It's LPG, SBLK, and Zim for the next 6 to 12 months and the long term. Thank you.
Hey, well, thanks for the question. Just to be fair to folks, we covered the 3 segments and we covered the 3 picks. So a lot of that's available on Value Investors Edge. Just to be fair to folks, I will say though, Starbulk is a dry bulk company, right? And so basically everything I said about Genco and everything I said about the rocky road to recovery, that certainly applies to Starbulk there.
Let's see. Another question about the Starbulk from John was asking, do you see them continuing the strength run and net cash positive with a strong dividend?
So Starbulk's dividend it's a formulaic variable dividend, and it's based on their free cash flows. So since the rates are lower, we're going to see smaller dividends, and we already saw that, right? In Q2, the results that just came out about a month ago, the dividend for Starbulk was lower, and so we should see that again in the next Q3 results in November. We should expect a really small dividend. Now they are considering the strength of their fleet and the strength of the balance sheet. They are above cash flow EBITDA break even. So we should still see maybe a tiny dividend. We shouldn't have any sort of distress, but don't expect huge dividends from Starbulk until those rates turn around. Because that's all it is. The dividend is based on how well the company performs. And they're very straightforward with it. I mentioned in that slide early on that Starbulk had returned 150% of their stock value in 3 years in dividends. So they're going to share the dividends when the time is right. But right now the rates are still pretty rocky.
Thank you very much. Let's finish off with this question that just came in from Nelson De Silva. Will those routes change once BRICS currency kicks in, if it hasn't kicked in yet?
Yeah, it's an interesting question. The BRICS trading regime, abandoning the petrodollar, as it were. We might see it a little bit different in that those sort of participating countries. However, you have to keep in mind that most of those participating countries and those participating routes are already kind of ignoring the sanctions regime, right? Like this is a US and European led sanctions regime. And so it's really only those countries that are 100% like abiding by this. Everyone else, there's a price cap, but the penalty measures are kind of weak and there's lots of holes in it. Like I actually studied sanctions and trade flows academically. And so there's a lot of interesting sort of like holes in these sanctions. So I don't think that BRICS thing in particular is going to make a big difference, because those are kind of the countries and trading routes that would normally kind of scoff at some of this stuff anyways. These trading routes are primarily going to impact US buyers, European buyers, Japanese, maybe Koreans, and those sorts of routes. And we're certainly seeing high sanction compliance from those countries. And I don't expect that to change.
All right, Jay, thanks so much. We do have a ton more questions, but we're out of time now. What's the best way for people to reach out for you or just learn more in general?
Yeah, thanks for asking here at the very end. Let me see if I get the slide. Yep. So I'm on Twitter at Mincemeyer. I guess it's called X now, so you can follow me for
Right.
free there. And then we have our full research platform, mincemeyer.com, and just the last name will take you there. And then we also have an entry level newsletter because I know some folks are saying like, the full service platform is great, but it's maybe a little bit outside of my budget. I'm not quite that much into shipping. So vielight.com, if you want to just take a screenshot real quick, that's the best way to get a hold of me.
Absolutely. All right, fantastic. All right, everyone. So that does conclude our time for this session. I know you guys had lots of questions. Feel free to take a screenshot here on the screen now if you want to reach out, get some more information. Jay, once again, thanks so much for a fantastic presentation. It's such a pleasure to have you on.
Absolutely. Thanks for having me.